A 22-year-old college graduate walks into a closing office carrying a backpack and iced coffee and less than $3,000 in savings. 2 hours later, he walks out owning a duplex that brings in more monthly cash flow than his first corporate paycheck. No rich parents, no lottery ticket, no six-figure salary, just strategy. And right now, all across America, Gen Z is quietly rewriting the rules of real estate investing while older generations are still arguing online about whether housing is too expensive. The truth is, Gen Z is finding ways to buy homes with almost no money down, and they're using systems, loopholes, financing programs, technology, and social media knowledge that most people still don't understand. What's even crazier is that many of these young buyers are turning real estate into passive income before they turn 25. So today, we're breaking down exactly how Gen Z is doing it, what strategies they're using, what risks nobody talks about, and why this trend could completely reshape the American housing market over the next decade. For years, people believed buying real estate required a massive down payment, perfect credit, and a stable high-paying career. That was the traditional American formula. Graduate college, get a good job, save for 10 years, then maybe buy a starter home in your 30s. But Gen Z grew up during economic chaos. They watched millennials struggle with student debt. They saw housing prices explode after the pandemic. They witnessed inflation destroy savings accounts. And instead of accepting the old system, they adapted to a completely different game. This generation understands leverage better than previous generations at the same age. They grew up surrounded by YouTube finance channels, TikTok investing clips, Reddit communities, Discord servers, and online creators openly discussing strategies that used to stay hidden inside expensive seminars or private investment circles. Information that once cost thousands of dollars is now free on a smartphone. The biggest mindset shift is this: Gen Z no longer sees a house as just a place to live. They see it as an income-producing asset. That single mindset change is transforming everything. Instead of asking, "Can I afford this house?" many young buyers ask, "Can this property help pay for itself?" And once you understand that perspective, the entire strategy starts making sense. One of the most popular methods Gen Z is using is called house hacking. This strategy has exploded across the United States because it allows young buyers to enter real estate with minimal upfront cash while dramatically reducing living expenses. Here's how it works. A buyer purchases a duplex, triplex, fourplex, or even a regular single-family home with extra rooms. Then they rent out part of the property while living in the rest. The rental income helps cover the mortgage payment, utilities, taxes, and insurance. In some cases, the owner lives nearly free. In other cases, the property actually produces positive monthly cash flow. Imagine a 24-year-old software engineer earning $70,000 a year. Instead of renting a luxury apartment in a major city for $2,000 per month, he buys a duplex using an FHA loan. The down payment is only 3.5%. On a $400,000 property, that's $14,000. Still a lot of money, but far less than the traditional 20% down payment many people assume is required. He lives in one unit and rents the other unit for $1,800 per month. Suddenly, his effective housing cost drops dramatically. Instead of paying rent, he's building equity while a tenant helps pay the mortgage. Now multiply that strategy across thousands of Gen Z buyers nationwide. That's exactly what's happening. The FHA loan has become one of the biggest entry points into real estate for younger Americans. Backed by the federal government, FHA loans were designed to help more people become homeowners. They allow lower down payments and more flexible FICO score requirements compared to conventional loans. Many first-time buyers qualify with credit scores far below what older generations believed was necessary. Some buyers even use down payment assistance programs to reduce upfront costs further. In certain states, grants and assistance packages can cover portions of closing costs or down payments entirely. And here's where things get even more interesting. Many Gen Z buyers are stacking strategies together. They're not relying on one trick. They're combining multiple systems at once. Someone might use an FHA loan, receive state down payment assistance, negotiate seller concessions to cover closing costs, then rent extra rooms through Airbnb or Facebook Marketplace. Suddenly, buying property with almost no money down becomes very real. Social media has accelerated this movement massively. 10 years ago, a beginner investor might spend months trying to learn real estate basics. Today, someone can open TikTok and watch a 23-year-old explain how they bought a property using seller financing in under 60 seconds. Whether every influencer tells the full truth is another conversation entirely, but the exposure to these concepts has completely changed financial awareness among younger Americans. Another major factor driving Gen Z into real estate is remote work. Before the pandemic, living near expensive downtown areas was often necessary for career growth. But remote jobs changed geography completely. A 25-year-old earning a New York salary can now buy property in Ohio, Texas, Tennessee, or parts of Florida where housing remains comparatively affordable. That geographic arbitrage is incredibly powerful. Instead of spending $4,000 monthly renting a tiny apartment in Manhattan, many young workers are buying investment-friendly properties in lower-cost markets and using rental income to offset expenses. Then there's the BRRRR strategy, one of the most talked about investing systems online. BRRRR stands for buy, rehab, rent, refinance, repeat. The concept sounds simple but requires discipline and risk tolerance. An investor buys an undervalued property, renovates it, rents it out, refinances based on the increased value, then pulls equity out to buy another property. Gen Z investors love this model because it creates the possibility of scaling faster without enormous starting capital. Some young investors are partnering with friends or siblings to split costs and qualify for larger deals. Partnership investing is another growing trend among younger buyers. Previous generations often focused heavily on individual ownership, but Gen Z appears far more open to collaborative wealth building. Two friends might combine savings for a down payment. Three siblings might purchase a multifamily property together. Some groups even form small LLCs to buy investment properties collectively. Technology makes this easier than ever. Shared spreadsheets, online banking, digital signatures, and investment apps simplify coordination in ways previous generations never experienced. Of course, not everything on social media reflects reality. Many creators glamorize real estate investing while hiding the financial stress behind the scenes. Owning property is expensive. Repairs happen constantly. Roofs fail. Water heaters break. Tenants stop paying rent. Property taxes rise. Insurance premiums surge. Interest rates fluctuate. One bad decision can financially crush an inexperienced investor. But despite those risks, Gen Z continues moving aggressively into real estate because they view traditional financial pathways as increasingly unstable. That perspective comes directly from economic conditions. Many young Americans feel homeownership may become impossible later if they wait too long. Housing prices have risen dramatically over the last decade. Inflation has eroded purchasing power. Student loan balances remain heavy for millions of borrowers. Rent prices in major cities continue climbing. So instead of waiting for perfect conditions, many Gen Z buyers are entering the market early using unconventional methods. One of those unconventional methods is seller financing. This is where the property seller acts like the bank. Instead of borrowing from a traditional mortgage lender, the buyer makes payments directly to the seller under negotiated terms. This arrangement can reduce barriers for buyers with limited cash reserves or unconventional income. In some cases, buyers negotiate lower down payments or flexible timelines. While seller financing isn't extremely common in traditional residential markets, it's becoming more discussed among younger investors looking for creative entry points. Another strategy gaining popularity is assumable mortgages. During periods of low interest rates, some government-backed loans become assumable, meaning a new buyer can take over the seller's existing mortgage terms. Imagine inheriting a 3% mortgage in a market where new loans exceed 7%. That difference can save hundreds or even thousands of dollars monthly. Gen Z buyers who understand these opportunities are often competing differently than traditional homebuyers. Technology also gives younger investors advantages previous generations lacked. Apps now allow instant market analysis, rental projections, mortgage estimates, neighborhood crime statistics, and even AI-powered investment evaluations. A buyer sitting in a coffee shop can analyze dozens of markets nationwide within minutes. Information asymmetry has collapsed, and when information becomes accessible, opportunity spreads faster. Short-term rentals also play a major role in Gen Z real estate strategies. Many young owners buy properties specifically designed for Airbnb income. In vacation markets, a single property can generate significantly more revenue through short-term rentals than traditional long-term leases. Some buyers intentionally purchase homes with separate entrances, finished basements, or guest houses to maximize rental flexibility. Others live in the property temporarily to satisfy owner-occupancy loan requirements, then convert the property into a full investment asset later. What's fascinating is how Gen Z approaches debt differently from older generations. Many young investors don't automatically fear debt. They differentiate between destructive debt and productive debt. Credit card debt used for consumer spending is viewed negatively, but mortgage debt tied to appreciating assets and rental income is often viewed as leverage. This psychological distinction changes behavior dramatically. Instead of avoiding debt entirely, they focus on controlling and optimizing it. Credit scores still matter enormously though. FICO scores influence mortgage rates, approval odds, and financing flexibility. Many Gen Z investors become obsessed with credit optimization early. They monitor utilization ratios, automate payments, track inquiries carefully, and use secured cards strategically. Some learn more about personal finance from YouTube creators than from formal education systems. Schools rarely teach mortgage underwriting, cash flow analysis, depreciation, tax benefits, or equity growth, so younger buyers educate themselves online. The tax advantages of real estate also attract younger investors. Rental property owners can deduct mortgage interest, maintenance expenses, depreciation, insurance costs, and property management fees. These deductions can reduce taxable income significantly. Some investors eventually use 1031 exchanges to defer capital gains taxes while scaling into larger properties. Others use real estate professional status strategies later in life to optimize taxes further. The IRS code contains enormous incentives for property ownership, and social media has made younger generations far more aware of those incentives. Another reason Gen Z is entering real estate earlier is the rise of side hustles and creator income. Traditional banks once prioritized predictable W-2 employment above all else, but modern income streams look different. Younger buyers may earn money from freelancing, content creation, affiliate marketing, banking, e-commerce stores, consulting, or online businesses. Mortgage qualification can become more complicated with non-traditional income, but many lenders are adapting. Bank statement loans and alternative underwriting methods are increasingly common for self-employed borrowers. Then there's the emotional side of the equation. Gen Z grew up during a period where financial independence became deeply tied to personal identity online. Owning property signals stability, success, and freedom. On platforms like TikTok and Instagram, real estate content performs extremely well because it combines aspiration with practicality. People love watching transformation stories. A small rundown duplex turning into a profitable investment property creates compelling content. This visibility reinforces the idea that ownership is achievable. But there's also a darker reality underneath the trend. Many young buyers are stretching financially to enter the market. Adjustable rate mortgages, rising insurance costs, hidden maintenance expenses, and market volatility creates serious risks. If rental income disappears or property values decline, highly leveraged investors can face enormous pressure. Some markets already show signs of overspeculation driven by investor demand. Interest rates changed the game significantly over the last few years. During the ultra-low rate era, borrowing money felt incredibly cheap. Investors rushed into the market aggressively. But when mortgage rates climbed, monthly payments increased sharply. This forced Gen Z investors to become even more creative. Some shifted towards smaller multifamily properties. Others moved into lower-cost states. Some focused heavily on co-living models where multiple tenants share housing expenses. Creativity became survival. Co-living itself is becoming a major real estate trend. Instead of renting an entire apartment alone, tenants rent private rooms while sharing common spaces. Young investors buy larger homes and maximize rental income room by room. In expensive cities, this model can dramatically improve property cash flow. Critics argue it reflects declining affordability, while supporters see it as an efficient adaptation to economic reality. Parents are also quietly playing a larger role than many people realize. Some Gen Z buyers receive family support through co-signing, gifted down payments, or inheritance transfers. While social media often promotes self-made investing stories, family financial assistance still influences many transactions. However, even with assistance, younger buyers are often leveraging programs and strategies that previous generations never considered. Another powerful force behind this movement is fear. Fear of missing out on ownership, fear of permanent renting, fear that inflation will continue making assets more expensive over time. Historically, real estate has served as a hedge against inflation because property values and rents often rise alongside broader price increases. Younger investors understand this. Many view owning real estate as protection against future economic uncertainty. And despite headlines about housing crashes or market slowdowns, demographic demand remains powerful. Millions of Americans still want homes. Immigration continues adding housing demand. Construction shortages persist in many regions. Zoning restrictions limit supply growth in major cities. These structural forces keep long-term housing conversations highly relevant. One of the smartest Gen Z strategies involves targeting overlooked markets instead of glamorous cities. Instead of chasing luxury condos in Los Angeles or Miami, many young investors focus on secondary cities with population growth, job expansion, and affordable entry prices. Cities in the Midwest and Southeast have attracted enormous attention because the numbers make more sense for cash flow investing. A property producing positive monthly income in Cleveland may outperform a trendy property in San Francisco, losing money every month. Data literacy is another Gen Z advantage. Younger investors analyze cap rates, cash-on-cash returns, debt service coverage ratios, and appreciation trends using tools previous generations rarely accessed early in life. They compare markets nationwide almost like stock investors analyzing companies. Real estate investing has become increasingly analytical and technology-driven. At the same time, there's growing debate about whether investor activity hurts affordability for ordinary families. Some critics argue that turning homes into investment assets increases competition and raises prices. Others argue investors provide needed rental housing and improve neglected properties. The reality is complex. Real estate exists simultaneously as shelter, investment, business, and social necessity. Those competing priorities create tension throughout the housing market. Artificial intelligence is beginning to reshape the process too. Investors now use AI tools for property analysis, renovation estimates, market prediction models, tenant screening assistance, and automated management systems. Younger generations adapt to these technologies rapidly because they're already comfortable integrating digital tools into daily financial decisions. Even retirement thinking is changing. Previous generations relied heavily on pensions or 401k growth through stock markets. Many Gen Z investors view rental income as an alternative retirement strategy. The idea of owning multiple cash-flowing properties by age 40 feels more tangible to some people than waiting decades for traditional retirement accounts to mature. And perhaps the most important lesson from this entire movement is that access to information changes financial behavior. The internet democratized financial education. Millions of young Americans now understand concepts that once stayed hidden behind expensive advisors, private networking groups, or business schools. Not every strategy works. Not every investor succeeds. But the knowledge barrier has collapsed. At the same time, time, there's growing debate about whether investor activity hurts affordability for ordinary families. Some critics argue that turning homes into investment assets increases competition and raises prices. Others argue investors provide needed rental housing and improve neglected properties. The reality is complex. Real estate exists simultaneously as shelter, investment, business, and social necessity. Those competing priorities create tension throughout the housing market. Artificial intelligence is beginning to reshape the process too. Investors now use AI tools for property analysis, renovation estimates, market prediction models, tenant screening assistance, and automated management systems. Younger generations adapt to these technologies rapidly because they're already comfortable integrating digital tools into daily financial decisions. Even retirement thinking is changing. Previous generations relied heavily on pensions or 401k growth through stock markets. Many Gen Z investors view rental income as an alternative retirement strategy. The idea of owning multiple cash-flowing properties by age 40 feels more tangible to some people than waiting decades for traditional retirement accounts to mature. And perhaps the most important lesson from this entire movement is that access to information changes financial behavior. The internet democratized financial education. Millions of young Americans now understand concepts that once stayed hidden behind expensive advisors, private networking groups, or business schools. Not every strategy works. Not every investor succeeds. But the knowledge barrier has collapsed. Still, there's a difference between education and execution. Watching real estate videos online is easy. Managing debt, dealing with contractors, handling tenants, surviving vacancies, and navigating economic downturns is much harder. Many Gen Z investors will succeed enormously. Others will learn painful lessons. That's true in every investment cycle. But whether people love this trend or hate it, one thing is undeniable. Gen Z is approaching real estate differently from previous generations. They move faster. They leverage technology more aggressively. They collaborate more openly. They prioritize cash flow earlier. They accept unconventional living situations temporarily to build long-term wealth. And most importantly, they no longer believe homeownership must follow traditional timelines. The idea that someone needs a perfect career, massive savings account, and decades of waiting before buying property is fading. In its place is a new model built around leverage, flexibility, digital education, creative financing, and income optimization. That shift could permanently change how Americans think about ownership. So when people ask how Gen Z is buying real estate with almost no money down, the answer isn't magic. It's strategy. It's government-backed financing. It's house hacking. It's partnerships. It's remote work. It's social media education. It's geographic flexibility. It's creative leverage. And above all, it's a generation adapting to economic conditions in real time instead of waiting for permission to build wealth. The bigger question now is what happens next. If younger generations continue entering real estate earlier through these methods, the long-term effects could ripple through the entire economy. Housing markets may become even more competitive. Financing products may evolve further. Co-living and shared ownership could become mainstream. Traditional ideas about home ownership may completely transform. And maybe the most fascinating part of all this is that the people leading the movement are often barely old enough to rent a car. That's the new American real estate game. And Gen Z learned the rules faster than anyone expected.